Hey guys, welcome back. Very popular guest that we've had on before. Similar of mindsets in many aspects to what I am in terms of opinion. Always great to get an update from Bill Holter. Bill, welcome and thank you for coming back on.
Thanks for having me back, Francis.
So there's been some interesting news from the Federal Reserve. It's been a bit of a twitchy period and quite active. I'm going to point to two recent articles, Bill. One inside which, and maybe even I'll bring in the share screen so that the readers can follow this with us. Um, there is apparently an undershoot on the original expectations of borrowing, or where previously they set a pretty high watermark in terms of what they expected for quarter one, and it's gone on to be slightly under that at a very somewhat very large nonetheless 760 billion required for quarter one. So what's your take to this lower than forecast that caused the bonds to rally and the rates to fall on 760 billion borrowing in quarter one?
Well, I would say it's like many of the other things they do. Uh, they Many of the other announcements that they make, they walk back. So they're able to walk this back and say, look, we're only borrowing $760 billion. Well, if you do the math, that's $3 trillion annualized. I mean, so how wonderful is
Insane.
that? The U.S. debt went up 2.5 or 2.6 trillion dollars last year, and they say that the deficit was only $1.5 trillion. Well, then if it was only $1.5 trillion, why did they have to borrow 2.6 trillion? It's
Yeah,
basically uh, it's I guess you could call it managing expectations.
indeed. Indeed. I think they're artists of great deception in terms of expectation management. Um, Throwing out that shock number and then hopeless, then overperforming by coming in under on it. The other Reuters article, who we know well, Reuters, and its following, Fed to allow the emergency bank lending program to expire on March the 11th. How do you think that pans out for them, Bill?
Well, like my response was prior to the call, good luck with that. I mean, they had to put it in place last year. If you remember, last March, you had the three or four banks in the U.S. blow up, and it was no small thing. If you added their assets together, the assets of those four banks were bigger than all the banks that went down back in 2008, 2009. So it was a really big deal. Now they're saying that they're going to they're just going to stop the lending facility. I would just say, can they really do that cold turkey? I mean, it makes. Let's look at it from a broader standpoint. The Western financial system as a whole has been on life support since 2008, 2009. There's not been any point in time where the central banks did not support the financial system, and they supported it to the point where back what I guess 5, 6, 7 years ago, there was the argument about negative interest rates, which is ridiculous because if you have negative interest rates, it means basically, and I'm not going to go into it, but it basically means that everything paper is worth nothing.
Yeah.
So they lowered interest rates to 0%. All of these sovereign treasuries all over the world borrowed like crazy because basically it was free to borrow. And I mean, looking at the U.S., the amount of debt outstanding more than doubled, yet the amount of interest paid out, the debt service, never really rose. It traded between uh, 350 to, I guess, the high level was about 500 billion in a year, and that was a function of the amount of debt was going up, but interest rates were continually going down. That didn't have the curtain pulled back on it until about a year, call it a year and a half ago, when the Fed was raising rates, the bond markets all over the Western world were crashing. And what happened when interest rates go up, bond prices go down. Bond prices are inverse to interest rates. So as these rates were going up, the bond prices were going down. And just to look at, uh, let's look at two things here. First, what that did was this past year, the U.S. has paid over $1 trillion in interest. That's now bigger than the military expenditure, and the U.S. spends more on the military than the rest of the world combined. So now you've got
Mm.
two items that represent well over 40% of incoming tax revenues. That's the first thing. The second thing is all of these Western central banks have literally blown themselves up. Looking at the Fed, they lost $113 billion last year on the value of their bond portfolios. Now, what is $113 billion? The last number I saw, and this was a couple years ago, the last number I saw was the Fed was operating with only $65 billion of equity. So in a year's time, they wiped out nearly double what their equity was. So you have the central bank that issues or backs the world's reserve currency is technically insolvent. Now, is there a problem? Will the Fed, default and not make any payments on anything? That can't happen because they can create dollars. Does that cause a problem where the Treasury bonds don't get paid? No, because the Treasury will just borrow more to make the interest payment, and the Fed will facilitate that. So you've got literally uh, in the Western world, you have two drunks walking down the street trying to hold each other up. You've got the central bank and the sovereign
Yeah.
treasury of all of these Western nations. They're all insolvent.
Yeah. Yeah, absolutely. And they're tinkering at the edges. It's only 760 billion, like you said, 3 trillion annualized. If they carry on at that rate, and it's more likely to have an uptick to the tail than a downward one. And we're talking about raising massive interest rate payments, as you've highlighted now, have transcending even the military expenditure. And the other thing that I always talk about, and that came up when we participated together, and I try to highlight it, but I'd like other people to hear this from a different person who's trusted and is of sound money principles. But I keep warning the following, and let me know you concur and put it in your own words for everyone to hear. Everybody thinks that the Fed is the ultimate go-to for interest rates, and initially they are in the short term, but when they abuse this continually, and then we end up in a cascading, ever greater fattening pipe of new issuance, in an environment where there's nobody in the room, everyone else is constipated and bloated, they've stuffed so many pizzas in their mouths, and here the guy comes with the next 100 pizzas for everybody to eat, and everyone's going, oh, no thanks please. And they say, no, there's more coming, and there's another bus behind me. That eventually the markets just says, look, we're not going to pay for that. In fact, we'll pay you to take it away. It almost has an inverse value. It's junk, and we'll do anything but that. That eventually the market will reprice the debt, and it doesn't matter if the Fed, due to recession, depression, loss of jobs, etc., bad news in the economy, wants to cut rates. They won't be allowed to issue debt anymore. And that's dollars, new dollars
Right.
through debt. And that's when they lose control. And that's when you get an interest rate spike, not because anyone wants the rates to go up, but because nobody wants the debt. They only talk about the rates and inflation as if it's an entirely contained and controlled situation. The other side of the seesaw is who's buying all the debt and who's going to chase it up and want more that the rates go down. What's your take on the fact that nobody talks about the other side of the seesaw? You eloquently stated, for the one to go up, the other must go down, the inverse relationship. And it's almost
Right.
like everybody microscopes on the one end.
Yeah, you're absolutely right. Let me try to break this down. First, let's go back 70 years, 60 years after World War II. The dollar was brand new at the being the world's reserve currency. There was no debt problem. Yes, we had a lot of debt. The U.S. did, but after the war, the manufacturing ability allowed us to pay the debt down, and it became normalized. What I want to get at here is even back then, the Federal Reserve only controlled short-term rates. Out probably the furthest out they could control rates would be 2 years. They couldn't control
Mm,
5, they couldn't control 10, and they surely could not control mortgage rates.
30s.
So
Yeah.
the point I'm trying to make is when we were a fiscally sound entity, both the Treasury and the Federal Reserve, they still could not control long-term rates. Those are market priced. Now, here we are in a period of time where it's clear that both the Federal Reserve and the Treasury are upside down. The Treasury is without a doubt, I mean, mathematically, they're going to have to borrow more and more and more and more. So let's look at from a supply and demand standpoint. That's what you're talking about, I believe, is
Yes.
when when there's more and more supply, then the brokers, the banks, the insurance companies, they get filled up to the gills and they can't take any more. This is happening at a time when Saudi Arabia has said that they will accept other currencies for oil. And I'm bringing this in because back in 1973, the only thing that saved the U.S. becoming a purely fiat currency was the 1973 oil deal, oil for uh, dollars only, and those dollars were going to be put back into the treasury market. That created guaranteed, yet if you want to call it artificial demand for the treasuries. It funded the deficits, is what it did. So here we are. And let me also mention that just before Christmas time, the United Arab Emirates had a statement of their own that said, we're going to accept all kinds of foreign currencies, but we will not accept dollars. So what I'm getting at is the demand for dollars is definitely waning. Now, let's look at the supply and demand. We know that there's going to be more supply because the US cannot self-fund. We have not self-funded since, call it 1960. So, the last
Yeah.
60 plus years. The and there is a point in time, and I think we're already there. There is a point in time where institutions don't have the appetite. They can't stomach the volume that the Treasury's issuing. You have foreign entities that over time have bought trillions of dollars. When I say foreign entities, not just, I'm not talking about just institutions. I'm also talking about central banks, the Bank of Japan, the Bank of China, the ECB, et cetera, et cetera. The two that stand out obviously are China and Japan. They bought, between the two of them, they bought well over 2 trillion worth of treasuries. Actually, I'm sorry, the number is much higher than that. Uh,
Yeah,
the point
that's just
being,
one
those
years of debt.
balances, yeah,
That's just the
the
single years
point I'm
of
trying to
debt.
make, those
Yeah.
balances have been shrinking now. Uh, they began probably around 2015, 16. They stopped buying, and then you started to see a little bit of shrinkage, and now you're seeing big
Yeah.
shrinkage. Who's buying that? Uh, the Federal Reserve has been known as the lender of last resort, and it's my opinion that before this is over, and when this panic and spike in interest rates that you're talking about happens, once we the Federal Reserve will be the buyer of only resort. They'll be the only
Yeah.
buyer on the planet. And
Yeah.
as interest rates rise, then you're going to have a panic move out of bonds because people, it's amazing that even today, many people don't understand that when interest rates go up, bond prices go down. It's the inverse of when rates come down, bond prices go up. Now, understand, Francis, that credit, debt, US Treasuries being the global reserve currency, those are the foundation to the entire financial system. And as interest rates go up, that foundation gets smaller and smaller and smaller. So you're hollowing out the foundation with higher interest rates, and you're creating the scenario where there's going to be a panic out of bonds because people are going to figure out that bonds are, what's the saying, certificates of guaranteed confiscation as far as purchasing power is concerned.
Yeah, yeah, yeah. Head for zero. I mean, to me, I'm amazed still by the number of people I come in, and many of them have their portfolios managed that are stuffed with bonds. They still have bonds and equities. And can I also say you're going to have to watch those money market accounts because that is based also. They've been a great
Absolutely.
thing. Go ahead. Yeah, give us your take on that.
Yeah,
Money market.
we saw that in late 2008, 2009. We saw a money market fund break the buck, and then of course the Feds came in and tried to calm that down. People don't understand. People don't generally don't understand money itself. I mean, I've seen all kinds of recently in the last month or so. I've seen all kinds of commercials on TV for Nerd Wallet, and I mean, you name it. And I'm thinking, what these younger people have not even a clue as to what money is. The 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 purpose people put into a money market, not it used to be, but not, and maybe a little bit now again since interest rates have risen, is not to make money. It's a place to park your money where you think it's safe. And people need to understand that the assets that are underlying these money market funds are basically corporate paper. So if you have corporations that are going out of business, that the paper that they issue becomes worth zero, and it dents the $1 dollar per dollar on the money market funds. So it's, yeah, that's a real danger. And one thing you mentioned, heading towards zero, when currencies go down, everything goes up. I mean, you could look at housing, you could look at stocks, you could look at anything. I just posted a chart yesterday on my website that showed uh, the stock market, the S&P 500 versus an ounce of gold. It's priced in gold, and literally where we stand right now, and it's come down since 20 since the year 2000, the dot-com bubble. But we're still back uh, at 1929 levels. So, and I mean, if you look at the Dow in terms of gold this century, it's actually down versus gold. So you've actually lost money, and people don't understand that. They look at their statements and they're like, "Wow, I made X amount of percent or X amount of dollars or whatever." But understand, your assets really aren't even going up as fast as the currencies. They're going up as fast
Losing.
as the currency's going down, but the
Yeah,
currency is going down uh, versus gold faster than the assets are going up.
yeah, yeah, yeah.
And one
That's
other
it.
thing you mentioned the word infinity. It's important for people to understand that when currencies go bust, everything, including a cup of coffee or a stick of chewing gum, becomes infinity when the currency goes to zero, because it means the currency will not work for any type of transaction.
Yeah. We've actually found our way to your site, and I encourage everyone to spot billholter.com. I'm not sure if you can see it, Bill. Do you want to actually show me where that
Yeah,
chart was, and I can pull it up? It's on your
I sent
first
it for
page.
post last night. Yeah, I sent it for post last night. I don't think it's up yet, but it should be up in the
Oh,
next,
okay.
you know, later today or early tomorrow.
No problem. But the point is made. In short, you're not preserving buying power against the rate at which
Correct.
they're expanding fiat. So I'm going to summarize, and you tell me what you'd addend, Bill, in terms of a contagion, because people want to know what do we do and what are the stages of this event unfolding, because it's not a single straw breaking a camel's back. It's actually a process that's been going for a long time. The camel is already straining immensely and pretty sick. But something along the lines of the recession gets worse. People are complaining, job losses are going down, tax receipts drop even further, or the projection therefore drop even further. This implies greater borrowing being needed actually by the government because income goes down, yet the liabilities remain as ever. We actually have these two dichotomy. I'm going to sidebar here. I'll come back to this whole scenario, but I just want to sidebar. We were discussing before we started all this plethora of mainstream medias all talking the war game that has to happen. You've got Australia, Sweden, the UK. We don't have enough soldiers. A war is imminent with Russia. Australia, a war imminent with Russia. I mean, just think of the geography of and the logistics involved in that ludicrous claim. But it's all the usual suspects managed by all the usual people. It'll be Canada and the States as well. Can't get enlisting. It sounds like an on-ramp for Terminator soldiers, and the dog with the paintball gun suddenly goes a bit live. I don't like where we're heading with that, but let's park that for a minute. At the same time, that narrative obviously pumps oil. We've got the oil price moving up, and they're all talking to us about how inflation is going to go down and rate cuts are needed. And on the other hand, are saying, don't allow it to happen too much. Let's talk up this big conflict, which they're probably going to instigate. They want to keep it warm as a narrative. It's totally coordinated through all the usual suspect nations. And at the same time, they expect inflation to go down. So I just want to highlight that dichotomy, and you can comment on that separately. But let's just go through the scenarios. Again, a further reduction in income take, an increase in issuance of debt, which then starts to have people balking at the concept of being purchasers of this debt. This leads to a contagion. It could involve some pensions battling with selling. We saw the Cal teachers' pension, the second largest in the US, have a problem and actually proposed the solution that they get given special permission to borrow up to 30 billion against illiquid assets that they can't sell without moving the market because they're so thin a bid, but they got a loan against that. I mean, you could literally have, and you'll excuse the phrase, a micro cap crypto token by a scammer that is bid up to this, and there's no bid under, that at any moment could be crashed to zero if more than a certain amount of volume. And you're starting to get that micro scammer vibe with bonds and pensions. So, I mean, it's absolutely remarkable. The only difference is there's a government that says, oh, no, don't drop that amount of bonds on the market. Let's see, we have to finesse this. Well, maybe we'll lend you some more money here and you can pledge asset as collateral. Marking to market. They don't want the mark to market to be forced to its true point in the absence of bid, because then everything is shown to be insolvent. So what ends up happening, a real bulk at the debt. Suddenly the people start distributing disorderly as much as they can inside constraints without wanting to look like the heavy seller. They're at a limit that they can get out every time, and they keep testing the bid. Fed is having to make that bid because no one else wants to buy. You made the point about them being buyer of last resort, and you said only, in fact. Not, and suddenly they start saying, hey, you guys can't, you're not allowed to sell anymore. There's some rules to that effect, but behind closed doors, causing a further panic. So privateers start to sell, and the interest rates, of course, as this drip spill. And hasn't we called the collapse of the euro Swiss franc in '09 and a second time on the peg. And there's that moment where everybody thinks it's a sure thing, and then it traded through 1.2 and it traded 1.1999. And then the market realizes, hey, they didn't come in, and it trades 19.95, 93, and then they realize there's nothing there and they all dump. And then the next thing you know, it's traded 82 cents. In an FX market, you had a 40% move because and the bid absence, and all the liquidity providers just stood back. So all the brokers took massive losses on clients that took much bigger losses than their margin could curtail, because everybody just said, no bid, no bid. We're not in the market, no bid. And the liquidity providers, the primary dealers, didn't put up an offer and didn't put up a bid under the market. So you had these vacuum gaps where everyone just chased down to get out and was taking ever bigger losses. Some of it will be algorithmic. And the bond equivalent of that starts to happen. That leads to an interest rate spike, which is disorderly. That sees the Fed rush out, like the Bank of England did when their currency came under attack from the Quantum Fund and George Soros, upping rates 2 or 3 times for a temporary liquidity problem, only for the rates to super spike well beyond what they've done and matters to be taken out of their hands, and everybody asking, but you're in charge of rates, only to find out the market's in charge of rates and the bond debt situation has gone no bid, and other simultaneous events taking place in the global coordinated, the Western world coordinated debt system. I don't think it'll be any better in China and any other country, so it will probably be global as well via relationship, but particularly affecting the Western nations. We end up in this rate super spike where the dollar then has a super spike, biggest military first, which crushes a bunch of currencies. Nations like Turkey, South Africa, or those with dollar debt can't pay. You end up with an entire, we can't pay, what do you want us to do? These lockdowns, they close markets, you get the freeze, you get the shutouts, internet downs, various retail traders won't be able to get out. And you go bidless for a number of days and they freeze the markets and you'll have no access. And then they will come with a temporary solution and some degree of liquidity that will be provided at some godforsaking air pocket low. And then that will start to a contagion of busts, declarations of busts of banks, because they're the primary dealers of the debt. They're sitting on too much. And so we go into the full reset where if you don't hold it and it's not physical, you don't own anything. And it comes down to a discussion we had on the Great Taking last time we spoke regarding shares, businesses, everything. And we go into a kind of lockdown that is similar to March 2020 without the biology theme. It's the financial theme. Because of unrest and social, they'll have groups that are getting rioting and going mad. Stay indoors, martial law. You know how they love control. The pandemic and wars give superpowers, and they love being in that space. We'll go into a financially driven one, or there's going to be a Russian hack narrative attached to also disperse the blame. And in that moment, we'll have a super spike in the dollar, then a subsequent very strong crash, and gold will be the only thing that anybody or everybody wants to hold, gold and silver. Where do you see, and what would you add and addend, detail-wise, or change in that that version, that looking forward, how's the movie going to run?
First, I think that was an excellent synopsis. Uh, Basically, what you described is the mathematical certainty of this happening. Uh, the only thing, the only thing I might change would be everything is so levered today, and on top of all the leverage, there's a $2 quadrillion market of derivatives.
Yes.
And it's my thought that once this thing actually does pop and they do lose control, it'll be all over in 72 hours. There will be
Yeah.
markets around the world will not open. Uh,
Mm.
I believe you talked about reset, and I think you're talking about the reset of uh, asset pricing in the West. I really think that the reset that's coming is between East and West,
Yeah.
and that we can segue that into war because if you have read any of Vladimir Putin's speeches, and I urge everyone to read, he's done 6 or 7 public speeches since uh,
You,
2022.
yeah.
If you read his speeches, the man is basically saying we want free, fair, and real settlement to trade. We just want to do business. And
Mm.
I think if you read any of his speeches or all of his speeches, I would challenge someone to 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 actually try to pick it apart and what do you not disagree with. I don't find much
Yeah.
in what he has said that anyone that is just open-minded and a true arbiter, if you will. I don't think anybody can find anything really wrong with what he said. Now,
Yeah.
we can talk about the war aspect of it because I do believe that's where this is headed. And I don't necessarily think it's headed this way because of Russia and China. Russia and China are more or less trying to do business with the rest of the world. They're trying to not use dollars. They're trying to uh, they built the Silk Road. They want to do trade, and they want to do trade in something that they can get paid for that's real. And
Yeah.
that's obviously, we're talking about the BRICS currency backing with gold, backing with oil, backing with other commodities. They're tired of the never pay model. And the never pay model is what the West has done with the dollar as the reserve currency. The dollar is backed by nothing. It's backed by the full faith and credit. The credit part is the joke there. It's backed by the full faith and credit of the United States. Well, the bottom line is they send something real in trade, and the West sends them dollars. Well, dollars, when all is said and done, are nothing. They have no real value whatsoever. Uh, and understand that wars are very, very expensive. So you have a West where we talked about the central banks, we talked about the sovereign treasuries. They're basically insolvent already. Wars are very, very expensive. And few people know that the debt to GDP in Russia, for example, is under 20%. Now, China does have a debt problem in their economy, in real estate. And I've said for years, I'm not so sure they really even care about that because the assets that they built will remain. They borrowed money to build stuff. We borrowed money to eat. That's the difference. Now,
Yeah.
back to Russia. If you look at what's happened militarily, when I say militarily, I'm not talking about conflict, I'm talking about weapons systems. If you look at what's happened with weapons systems over just say the last 5 years, the US still has not had one successful hypersonic test. Russia actually has hypersonic weapons. Um, and my uh, late business partner Jim Sinclair used to say, if you can't catch it, you can't kill it. So
Exactly.
it looks to me that Russia is they do have military superiority, and this is going on. I said, for the last 5 years. For the last 5 years, what have you seen out of the leadership of America? You're watching generals, you're watching admirals wearing skirts and dresses and makeup because they want to be inclusive. I bet that scares the living shit out of the Chinese and Russians. Um, and one last thing I do want to mention, just I guess to prove that gold is not a barbarous relic. If you go back in history and you look uh, at wars or conflicts, what does the winner always do? What's the first thing they do? They take the
Go
gold.
and seize the gold.
If you go back,
Hitler went to
right?
France's gold, and the West had removed it all. That's the first thing
Well,
everyone
even
protects, and it's the first thing they go to.
well, Yamashita's gold, they hit it. But if you look, even when I say recently, Saddam Hussein, Muammar
Ukraine.
Gaddafi,
Yeah.
and what's the first thing? What is the first thing the West did? They went and they took the gold. So it
Yeah.
has to have some special meaning to the powers that be in the West. They have to truly understand that gold is real. It is money. It's the ultimate money. It cannot default. It's power. Uh, but they don't want the people to have it, which is why they have the media consistently say, "Oh, it's a pet rock. It's a barbarous relic. You don't want it. It's scary, scary." But it is. If they're doing it, if it's what they go to, you should go to it also.